Good afternoon, everyone. This is Lisa Rafter, the publisher of The Monitor. We are scheduled to begin our live stream at this moment. However, lots of people are joining literally by the second. So if you just hold on for a minute, we're going to wait till we've got most people joined in, and then we'll be back. So stay tuned. Hello, everyone. This is Lisa Rafter, the publisher of The Monitor. If you just joined, we're still waiting for people. They're joining by the second, so we're going to start in just a minute. So just stay tuned, and I'll be right back. Good afternoon, everyone. This is Lisa Rafter. Welcome to our live stream today. This is the second part in a three-part series that we started last week. And we've asked the panelists who you can see now joining on your screen to continue our conversation about asking the C-suite what's next for equipment finance. Last week, we were joined by hundreds of equipment finance professionals. It looks to be the same today as people are still joining. And we're so excited to have what we think is a really important conversation in today's environment, and that changes daily, weekly, monthly. We're all in different parts of the country, so we're all dealing with different aspects of this. And we think in the equipment finance world, there's just still so much more to learn about, understand, think about. So again, we've got a great group of people today to address this issue. So in a minute, I'm going to introduce you to our moderator. But first, I'd like to thank our sponsors. So we have Rinaldi Advisory Services, and we also have Odessa. So let me say a few words about our platinum sponsor, Odessa. Today's live event is brought to you by Odessa, the world's most trusted asset finance platform. The Odessa platform gives you the visibility and control needed to make smart decisions and grow with confidence. Save time and money and gain agility and scale by managing your leasing operations in one place in real time. Start your business transformational journey today by visiting odessainc.com. Okay, and now I'm going to introduce our moderator, who also moderated our session last week, Vince Belcastro. Many of you know Vince, but let me give you a little bit of Vince's background. So Vince is the group head, Element Fleet Finance, LLC. Vince is a senior banking executive with a diverse background in a wide array of sectors in commercial lending, risk analysis, and valuations in both the middle market and the large corporate sectors. He has an entrepreneurial background with strong expertise in managing new business, operational, and strategic platforms. Currently, Vince is the group head syndications at Element Fleet Finance, responsible for the build out and growth of a group that will focus on financing and sell-side activities for structured equipment lending and leasing. Prior to this role, Belcastro started a large-term lending business at Santander Bank, where he served as group head of equipment finance. Vince is also a member of the Monitor's editorial board. Vince, thank you very much, and I'm going to leave it now to you.
Well, thank you, Lisa. I appreciate the hearty welcome, and I look forward to quite frankly, in engaging in an interesting panel discussion, which hopefully everyone will find a lot of value in, given how the world has been turned upside down in such a short period of time. We really are living through unprecedented times, and as such, it's been fantastic to see the Monitor respond with a great series of number 2 in a series of 3 of events shaped to ask the C-suite and, quite frankly, give thought-provoking Q&A to hopefully help some of you navigate these turbulent times. Some of the theme here is credit. We are in a credit-driven industry, so generally you'll see some of the questions around that and how do we navigate approvals and so forth and so on. We will have a Q&A. You can ask the questions as we go along. We will more than most likely answer most towards the end. We'll also have a chat session. Lisa will moderate the chat function and attempt to, answer any of those questions that make more sense on chat versus a live function. So please feel free to take advantage of both. I'm excited to introduce a very dynamic group of panelists that I think will help us shed a lot of light into the current situation in the smaller ticket arenas and to a large degree some of the small end of the mid-ticket arenas, and in one case with John Dean, who is the CEO of our favorite one of our favorite consulting firms, right, Alta, and he has obviously many years of experience across the spectrum. So welcome to John Dean, and thank you for participating once again, CEO of Alta Consulting. Rob Boyer comes to us with many years of experience in across the platform, but largely the smaller ticket arenas. And he is the president of Truist Financial, which previously was which is now a combination of SunTrust and I'm sorry, who was the other? BB&T. Previously was at BB&T, and then First Niagara in a leading role for a long time since his First Niagara days. So welcome and thank you, Rob. Terry Jennings, who's the president of, hailing from the West Coast, who's the president of Financial Pacific Financial Company. And, again, many years of experience in our sector and has successfully run a good-sized business at Financial Pacific for quite a long time. I'm sure he will be, very accretive to our conversation, as he always is. Thank you, Terry, and thank you for joining. And here's a guy who's lived through a couple of terms, so we'll look forward to hearing from you. And then our wholesale modeling, credit, default, everything else specialist, Tom Ware, who is the president of Tom Ware LLC. Previously spent a good part of his career at various institutions. And quite frankly, has a deep knowledge of both credit analysis in our business, the technical credit side, predictive analytics, and so forth and so on. And welcome, Tom. I'm glad you have been able to spend this time with us, and I know a lot of people will be focused on some of the questions that come that will be directed towards you. So we look forward to you engaging in the panel. So with that, we will get into a couple of questions, and then also at some point we will basically have a poll after we get through the back and forth. We'll have a poll which is sponsored by our Odessa. And quite frankly, you can answer that poll as we go along and so forth. And then we will, talk about, if we have time, talk about the results. And at the end of the program, as well as go through some of the questions. So please see the link to the poll. And, thank you for participating. It's a great, healthy audience, and we're happy to have you here. So I'll kick it off and we'll go around the table. And look, this is not a surprise to anyone. We've had such financial shock caused by the COVID-19 pandemic. And coupled with that, unfortunately, smaller and medium-sized businesses, I think, are bearing the thrust of the pain. So the question becomes, look, you're managing the portfolio at hand is first and foremost. And that money's out the door and accounted for, and so we're all seeing deferrals, deferments, and what have you. But in that vein, quite frankly, we also have new approvals and new applications coming in every day. And so the question is, given the situation at hand, given the economy today, quite frankly, what are we all doing to adjust our business models to compensate for the new risk factors we have here? So I'll start, with John Dean. John, I'm sure you're getting a lot of these questions from some of your clients, and that list is obviously long. So John, would love to hear from you. Let us know what you're seeing in the space.
Well, let me respond first by maybe adding a little bit of perspective to this. For those of us that have been in this industry for a long time, there seems to be something approximating a 20-year cycle. So going back into the very early 1980s, the ELFA had its last convention in Las Vegas. And that was the time, when the stock market, the very day of Monday of the opening session at the convention, where prior to the Great Depression, the stock market had never fallen that much in one day. It was also a time when a higher percentage of ELFA members were independent companies. And so a major decline in the stock market hit them right in the pocketbook. And I can remember in those days, people, including myself, wandering around in a state of shock, trying to figure out what was going to happen next. Then approximately 20 years later, we had the perfect storm. where a number of large, impressive, significant leasing companies essentially went out of business, partly because of the tech bubble, partly for other reasons. And again, many of us wandered around trying to unfog our crystal ball, saying what's going to happen next. And now, just about 20 years later, we have the coronavirus pandemic, which hasn't come on faster than anything else. The first event I mentioned, the drop in the stock market, happened all in one day. But certainly where we have implications for the industry and the future of our individual companies that leave most of us wondering. What we are hearing from our clients is varied. So the answer, Vince, to your question is it kind of depends. We hear from some that the situation is pretty dire at the moment, that delinquencies, if not defaults, are approaching record levels, where their funding sources are understandably starting to dig in their heels and are pretty nervous about whether to continue with the program. At the other end of the spectrum, we're hearing from clients who say, of course, we're being impacted by this. There's major confusion in the market, but some are having near normal new business volume performance in the last couple of months. And so, again, I think the answer to the question is it depends. It's not a one-size-fits-all question or answer.
Yeah. And I certainly agree with you. It is going to be very different depending on what side of the credit spectrum you play on. So I can share with you here at firsthand. Look, we're even here at Element, we're blessed with a very strong client base of either investment grade or near investment grade clients, and there's a good mix of Bs and single and double Bs. And look, we're seeing noise across the platform, and at the end of the day, it's we're also lucky enough to have a very stable client base which is performing well. So it really does depend on what side of the spectrum you play on. And sure, some industries are winners and some industries are losers, and it'd be interesting to, as we go around the horn, to figure out, what else we're seeing along those lines. So Rob, I want to shift it to you, and just a minor correction. Rob is the president of BB&T Capital Corp, presumably a division of BB&T and then Truist, which recently went through a merger. So Rob, we'll turn it over to you. And tell me what you're seeing in your business, and what's happening. How are you adjusting your models and your forecasting approvals to account for some of the challenges ahead? So,
sure, and thanks for the clarification, Vince. Appreciate that. What we've seen really so far, well, obviously reacting to the change in the environment, and obviously the assumptive perspective that. Yeah, we have more risk now in the portfolio. There's more risk in general due to the pandemic. So we basically have turned off our auto decisioning, and we're relying on 100% human adjudication with all the transactions that we have coming in. Now, fortunately, we've also seen maybe about a 20% reduction in the volume of applications over the last 2 months. So it's enabled us to have adequate capacity to do that. But there's just some factors that we haven't been able to build into modeling yet, about how to screen out potentially some higher risk industries that we've identified, that we've observed through the amount of relief requests that we've seen within the portfolio. We're also, looking at certain geographic locations and, anticipating maybe some greater levels of risk, like the New York metropolitan area, where we've seen, a high level of impact, a lot of business closure, a lot of relief requests. So we're kind of looking at all those dynamics when we do our credit adjudication now. And, if they're in a higher risk industry, or they're, maybe in a high risk geography, we're asking some, basic questions. It's about 5 or 6 questions that we'll get answers on a standard questionnaire we've prepared to give our credit analysts a little more perspective on the risk in order to make a better informed decision. So.
Mm. Well, so that's interesting. You could bring up a good point, and you know, certain geographical areas are certainly hit harder than others. I mean, obviously in the New York, Pennsylvania, New Jersey areas, we've had cataclysmic, you know, change up here with what's happening in places like Philadelphia, New York. You know, certainly the larger towns in Connecticut, like Stamford and Hartford and what have you. I mean, these are certainly pockets of you know, COVID challenges, and those businesses are certainly harder impacted. You know, equally on the West Coast, Terry, I think, can you weigh in and give us some perspective on what Financial Pacific is doing about this situation, what you're seeing on, you know, obviously yours is a national business like all our businesses here, but you know, what are you finding? What are you seeing? You know, and what kind of adjustments are you making at FinPac?
Sure. Well, just for a little perspective, Financial Pacific's portfolio is filled with small businesses, lots of small businesses, closely held companies, and diversified into many different industries and credit qualities. We certainly have a lot of customers that have been impacted by this pandemic. We have done a lot of analysis of the profiles of the customers that have come to us asking for some payment relief. And we think that's just real good firsthand view of the types of companies that are experiencing the most stress during this pandemic. We looked at the frequency of relief requests by many different variables, such as industry, equipment, state, credit scores, origination sources, contract balances, and payment amounts. And we use this analysis to help guide us on some temporary changes to our credit window that we felt were appropriate given today's environment. From a industry perspective, not a lot of surprises here on which industries were most impacted, based on the types of companies that had to close or were limited with the stay-at-home orders. Those were the types of companies that we saw the highest frequency of payment deferral requests. In last week's call, it was mentioned that healthcare was surprisingly impacted, and we certainly saw that in our portfolio as well, and also in the dental area. Both those areas, as well as other businesses, are starting to open up again, so hopefully that will be a good news on the horizon coming up for them.
Yeah.
One area that we found maybe a little surprising to the positive side was automotive repair. The percentage of customers within our automotive repair segment weren't requesting deferrals at the same frequency as other types of, I'll say, retail type businesses. I think the high level takeaway from the industry analysis is just that how this pandemic has impacted virtually every industry to some degree. There weren't many, at least in our small business portfolio, that seem to have escaped a material impact. From a state standpoint, there was some variability between states, but not as much as I would have thought there was going to be. Credit scores, we looked at both industry scores and our internal proprietary scores. And there is some rank ordering of deferral frequency based on credit scores, but again, probably not as much as I would have predicted. Good credit scores and second-tier credit scores were equally impacted by the stay-at-home orders that some states have. And you know, we had strong credits that had been longtime customers making payments on time all the time, and all of a sudden they were shut down. And so, you know, I think when companies got shut down or were limited, it didn't really matter sometimes what the credit quality was of those businesses. So we'll kind of see as these deferral plans are ending here in the next couple of months, if credit quality has an impact of how easily they'll come out of that or not.
Mm-hmm.
One area that seemed to be just a little more predictive, at least in our portfolio, was the size of the monthly payment. The frequency of deferral requests for contracts with smaller payment amounts was much less than contracts with larger payments. So I guess that just goes to show how maybe material that a payment amount is to a small business. If it's a small payment, maybe they can feel they can just keep making those payments. But if it's a larger payment, they took steps to get more relief from those payment amounts.
Yeah. Well, interesting, since you know, you all, and I'll direct it to you, Terry, because you're on, but if someone else wants to jump in. So, you know, there's been a lot of government support through the PPL and so forth and so on. Are you finding that your clients are taking advantage of these government support programs, whether it be SBA loans or the Payroll Protection Act, PPA, or, you know, is that helping? Or is it just a little bit too much too late, or something like that, or too little too late? What are your views on that, Terry? And then I'll ask Rob the same thing.
Well, we don't have real clear visibility to our wide customer base as to which ones took advantage of the Triple P or which ones haven't. I'm sure it will have a positive effect for those that did take advantage of that. And I guess time will tell on the survivors and the ones that don't, how much impact that ultimately will have had.
Yeah. So, Rob, what are you getting any feedback
Sure,
from
Vince.
clients here in a very similar market as Terry? So just wondering what your,
Yeah, we definitely are. I mean, we've definitely seen a lot of people or talked to a lot of clients, and anecdotally, we're getting a lot of feedback that clients are applying for PPP. We've had a lot of clients that requested relief, decided not to actually take the relief once they were approved for PPP. So it's definitely having an impact. We've had clients that did request relief and now have gotten their PPP loan, and now they want to, restart their payments again without waiting for the deferral period that we had given them originally. So, yeah, I think, what we probably saw at the beginning, Vince, was we had a lot of people that maybe came and requested relief because of the high level of uncertainty. They weren't really sure what was going to happen, but, they just didn't want to get in a situation where they had a problem with a creditor. So they asked for relief. So I think, the stimulus that the government's put forward is really, really helping. I think it is stemming, some of the pain that our clients are seeing in the market, but, who knows how long it lasts, right? So I guess that's the big question. Right?
Sure. And Tom, just to come around, and love to hear your views on this. So, what are you hearing from your clients? I mean, you've spent a lot of time at PayNet. Quite frankly, you have sort of been on the other side of helping us predict, and we'll get into this predictive analytics later, but you've been on that side of it as well. I mean, what are you hearing from your clients? What are you seeing? I mean, please feel free to weigh in.
Well, you've got a great group here, so some of the stuff would be repetitive. But one of the things that I definitely hear is that people are getting away from auto decisioning. That I think what a fair number of people are doing is to take their same credit process that they had before, and if somebody doesn't meet that, just forget about it. But then, if they do pass that, then you go through the series of 5 or 6 questions, as Rob was talking about. And I do think, what Terry was talking about, what I thought was particularly interesting, because it was something I was going to mention, is that what you can do is build a model based on the information you have about who's requesting deferrals. So that information is gold. It's also who's delinquent now if the deferral requests are being denied. But that it's your best information as to what industries are hurting. You could also harvest the information about what industries you're getting credit requests for. That, to take an obvious example, I think there are probably very few requests from restaurants. Well, that you would want to, whatever industries you rarely see, be extra cautious on those. I think some people are focusing on which states are open, and I would caution on that, because I think that's kind of short term. That I can tell you in 1918 that of the 40 major cities, that more than a third of them reclosed after a second wave hit. And I would focus more on population density. that the risk in a place like Wyoming versus New York City, just inherently, you've got built-in social distancing based on, how close people are to each other. And I think in the long run that will persist and make a huge difference. And, lastly, focus by state, that the unemployment by state ranges from under 8% for Connecticut with a lot of white collar jobs to over 28% in Nevada with a lot of hotels, restaurants, casinos. I mean, it's industry driven, but it's certainly going to affect all the businesses in that geography. So I'd look at those things.
Yeah. Well, it's interesting, since we're on that subject, I'm going to stay with you for a minute. Quite frankly, as we manage through these unprecedented times, potentially this is, a downturn that's worse than 2008, and that it's affecting Main Street more than, quite frankly, the financial universe of companies. And it's driven by a much larger issue, a pandemic, versus a financial collapse of mortgage loans, if you will. So, Tom, are you, look, you spent a lot of time at PayNet, and that's a lot of PayNet is obviously, on top of credit default data, it's predictive analytics.
Yep.
So, would you expect that there could be any modeling change, whether it's through PayNet or some other providers, or, even internal credit managers that are available to quite frankly, navigate and help our credit approvers and so forth use the predictive analytics to manage through credit approvals? What type of data might be out there for clients that they can sort of rely on?
I listened to a webinar recently, the Monitor, with Bob Rinaldi, Bill Phelan, and Amanda Hull, and I very much agree with what they were saying. It's really going to be a challenge to build any kind of new models until you actually have defaults. That said, that one thing that's nice about PayNet Master Score is that it builds things like unemployment into it. So in a way, the model adjusts itself, and its scores will naturally be lower because of that in the geographies that are higher risk. In terms of building a separate model, I think in a way, what Terry did is probably the most that you can really do. The other thing I'll just mention is about scores is, someone else mentioned this before, but that the score you get at a given level, given score level, given point in the economy will vary quite a bit. And for a given score level, the defaults we're going to see on the business booked in the last 6 or 12 months is going to be as bad as, say, 2008. But that said, the good news is that coming out of a recession, it's actually probably the best time to lend. That whether that's 3, 6, 9 months from now, you could debate, but it's there very much is a cycle in default rates that for a given score level to keep in mind.
Mm-hmm. Okay, thank you. And John, you too are probably at the forefront of these questions, given all your consulting work in our industry and beyond. And I guess same question that I'll ask you. What kind of advice would you give our audience, our credit folks? What kind of questioning is Alta getting from their various clients that you feel comfortable sharing? Please feel free to weigh in.
My response would be additive to the discussion we've had so far about credit scoring or modeling, and really looking at a remodel of the entire business structure, whether something like that is appropriate for individual leasing companies or equipment finance companies. It was just a few years ago where lots of discussion about managed services transactions or managed solutions transactions. One of our clients, a large and successful captive, went through the exercise of completely restructuring its business model because a much higher percentage of its new business was coming from non-traditional services-related activities. That was a very positive environment. They were moving to accommodate a change, positive change, opportunistic change in the market. Today, we of course don't yet know how long this is going to take. We don't know the ramifications over time yet, but it's at least possible that it's going to take longer than any of us would like. It is going to fundamentally challenge some of the guideposts that we've all used in the industry, whether it be leverage or what kind of margin we need or what kind of provision we're using. And so one of the series of questions that we're getting most often from clients these days is, well, let's play kind of a negative what if, meaning that all of those things happen and not in our favor. What do we need to do to change our go-forward model so that we're still here in 2 years or 18 months or whatever when the recovery finally starts? And again, there's no one-size-fits-all to that. It really depends very much on the set of circumstances. In some cases, it can be throwing additional equity to support the balance sheet to get through a pretty rough time. At the other end of the spectrum, it can be a company that basically has to start looking to sell itself because it's not going to have the time or the flexibility to get through to a little bit calmer set of waters.
Yeah, that's assuming that values are there for, acquisitions to even occur. It's going to be very interesting to see how this affects valuations. And I would argue that from my perspective and only my perspective, look, it's kind of hard because we're at the forefront of all this, right? And we have record unemployment. When that comes back is anyone's guess. And sooner or later, in a consumer-driven economy that we all live in, that sort of, catches up beyond even the obvious of things like automotive, energy, aviation, et cetera. I mean, there's just a lot of grenades out there and landmines that we'll have to navigate through. So, but listen, thanks, John. Thank you, John. That's, quite insightful as always. Back to Terry and Rob, I guess, look, you argue the question, you argue the change, I'm not sure what you're seeing in current volume, but has there been a wholesale change in the forward business strategy that, you had laid out during early first quarter before the pandemic, or even late last year in some cases for your executive officers, for your board? Is it leading to a change this early on in reforecasting year-end budgets and so forth? Rob, can you weigh in and let us know what your thoughts are?
Sure.
I'm sure you're not alone. So.
Yeah, I would say on I guess part one of that question, Vince, we've not really made any adjustments to our business model per se. We've not really changed what we would anticipate to look at from a business development perspective strategically, but yeah, we've certainly reforecasted what we anticipate volumes to be this year based on the impact of the pandemic. We've forecasted lower than that, lower than what we had originally planned, obviously. But one thing that we're pleasantly surprised by is we're really actually still seeing a fair amount of new business volume come in, more than we had expected. In fact, we had beat our original number for April that we forecasted in our plan back, before the beginning of the year, just through normal business. So it's still holding up pretty well in a new business volume perspective. And again, we're actually seeing some increases in applications, in the last 2 weeks. So, maybe some of this concept of things opening up a little bit and people becoming a little more optimistic about things from that smaller to lower middle market type business perspective is starting to, show some impact on our volume. So.
Yeah, and so that's pleasant. That's a pleasant surprise, and you're not the first one I've heard that from. So I guess the question becomes, are you seeing this across new CapEx? Is it a situation where, or just where a situation of people looking to refinance because of lower rates? I mean, what do you think is driving that metric?
No, it's new CapEx primarily. What's driving it? You know, I have a couple theories, and they're just theories at this point. I don't think we have enough, time behind this and enough consistency to say what's driving it. The things I think about, and I'm not certain about, but I think, there could be a couple things going on now. There could be, maybe some tightening at some of our competitors that's really, driving a little more opportunity our way. It could be that, some of them have maybe moved up market or out of certain industries that we're still considering financing equipment for. I also think that really, I mean, if you think about one of the big competitors we have across the platform on an industry perspective, you have a lot of banks, community banks that do a lot of equipment financing for their clients, just, standard equipment loans. Well, a lot of those banks have been pretty busy with PPP over the last, couple weeks or even the last month. So it could be a situation where that conventional bank financing hasn't been utilized as much just because there hasn't been capacity for it. And that's making, its way into some of the specialty companies like us that have capacity to handle it. So, but yeah, it's still kind of early to really see, from a trend perspective, what we're going to see, over the next 6 months or through the end of the year. So,
yeah. Great. Thanks. And that's actually good to hear. Terry, any further insight from you on this situation here and what's happening with your projections?
Yeah, I'm going to end up echoing a lot of Rob's comments there. No, we haven't made any wholesale changes to our origination strategies at least in the channels we do business in. We're still operating in these same different origination channels. But yes, we have seen a change in what we're forecasting for our annual originations. There's just been too much uncertainty related to the COVID impacts in the last few months that it hasn't been business as usual regarding origination. So we've made temporary changes to our credit window, as I mentioned before, and those changes have and will continue to have an impact on our origination volume, but that's okay. We feel it's the appropriate thing to do in this environment. And those changes were intended to be temporary because it was business that we enjoyed doing pre-COVID. And so time will tell when and how we'll relax those temporary changes in the future.
Yeah, great. Well, good.
In terms of volume right now, similar to Rob, I'm a little surprised at the amount of application volume that we're seeing right now. It seems to be fairly brisk. And in some of the channels we do business in, it might be a little bit of a supply and demand where some of the other lenders have pulled back a little bit more. And so that maybe our market share goes up a little bit during these times. That would be similar to other economic cycles that we've seen.
Yeah, it's really an interesting dynamic. I guess the question for both of you is, and it's so hard. It's so hard as leaders of our spaces to kind of get a real, kind of handle on the current situation. But I guess it just begs the question, do we think this is sustainable? Do we think that, this lasts beyond the short term? Is it more than a quarter out there that we see this increase in volume? Terry, what are your thoughts there?
Oh, you're right. It is hard to try to figure out, but I think things will move and we'll be able to adapt along the way. We'll be nimble throughout this, and states are starting to open up some more. I just heard stories about people over the Memorial Day weekend and vacationing and going to resort areas and the hotels being at capacity. And so this thing may move a little quicker than we thought, or it may have a second wave come at us too. So we're just going to have to kind of roll with this thing a little bit and make the best decisions we can along the way.
Yeah, tough times. Rob, what are your thoughts? Sustainable, not sustainable?
Well, I guess I'm a little, like Terry, I think, we're seeing some optimism start to creep in because there's been, some positive things going on with reopening and, people sort of getting back to life as usual. I still think there are still big segments of the economy that are going to be, shut down. Or I don't know that like, I'll look at New York City, for example, and you're familiar with New York City, I'm sure, being so close to it, but just think about restaurants in New York City and how close they have to pack people in there to make it work, right? Just because of the real estate costs and everything else you have there. So I still think we're going to see a lot of, areas of the economy really have a hard time coming back until, this thing's pretty low as far as the risk of getting sick goes. And, maybe we have a vaccine that's issued within a year and that kind of, just completely ends this for us. But through that period of time, until there's that type of certainty that we have, I'm a little concerned that we're going to see some resurgence potentially. They talk a lot about potentially that happens in the fall. It'll be interesting to observe what happens in some of these places that open up almost completely to see, how the case counts start to move. Are they able to remain stable, continue to reduce, or are they going to, shoot up, and then it's going to create maybe another wave of fear that we have to deal with. So, and it's curious because there's a lot of dynamics going on. There's the new business dynamic, and you're trying to project what you're going to do this year and how things are going to work out from a revenue perspective. But then there's always the risk management side of it too. What are we going to anticipate? We're going to have to do to continue to serve our clients and work with them to enable them to get through this period of time. So it's, it's going to be interesting. I think the uncertainty level is still pretty high and hard to really gauge what's going to happen. So it's unfortunate that we need to be in more of a reactive position right now than a strategic position because, trying to plan for this is just difficult. So it's just, keep flexibility in your plan. You're going to need it. So.
Yeah, I agree with you. And unfortunately, the record amounts of unemployment loom, and it's just going to take a long time for that to catch up, right? I mean, there's just so much out there in the way of noise. So, listen, I have one question since we're talking about this, and then we'll go to a commercial break, just that I think probably makes sense given your last comment, Rob. So I'm going to just ask this question. It actually comes in from Jordan Segusa, and thank you, Jordan, for a very insightful question here. The question is, are you re-amortizing the remaining payments at the contract rate after the deferral? And then how are you handling customers who declined the modification after only a 1-month deferral, if that's happened to you? So I guess, I'll ask you, Rob, since you're on the wire, and then, I need
Sure.
one of our panelists that wants to chime in.
Yeah, so we've actually, wave one, I'll call it, which is that first initial wave. We had a lot of clients call in and request to have relief, and we had deferred payments, generally deferred for 90 days. And what we actually did was we kept the remaining payment stream the same. The payment remained the same. We made an adjustment to the last payment, which was an increase, right, to cover that interest difference, to maintain that rate on the contract that we have. Now we're looking at the wave coming, which we assume is coming, the next 90-day request, which we anticipate from some of the the really hard-hit industries are going to continue to need relief. We've decided that we're actually going to recalculate the remaining payment stream to, I think it just provides a little more relief, reduces the total amount of interest paid by the client, and just enable that to, pay out. And the other question was, what about the rate relief? And there was a two-part to that, Vince. The modification deferral. Yeah,
Yes.
We've seen that happen, as I had mentioned before, right? So we've been accommodating those requests as much as we can. It hasn't been a situation where we've had too many to handle. So we've been unfortunately doing a lot of administrative work to make the first change, and then change again when someone says, hey, I got my PPP loan, I want to start making payments again. But from our perspective, it's as much as we can do that, which we can right now, we're gonna help our clients do what they need to do to get through this and create the least amount of impact to them, and so it's been our MO so far.
Yeah. Tom, are you hearing anything from your clients on this?
In terms of the restructuring,
Yeah, how they're restructuring it, what they're doing with the deferrals and so forth, and, and
I think most people are maintaining their rate in the deal, that they don't want to give that away. And whether or not, I think keeping the payment the same is probably the most common. Seems pretty easy. And whether you have one big payment at the end or three or so regular payments at the end, it could go either way. But I think most people want the rate that they had and don't want to give that up, especially with greater risk now that you need arguably more pricing today.
yeah, and I agree with your comments. So we're across the board, even at Element, in some instances where we can get increased adders, we certainly try. But we're trying to also, where it makes sense, because we've gotten requests from some really healthy companies that don't necessarily deserve it, but where it makes sense, we're trying to help the customers anywhere possible. I think that's the right thing. So
yeah, I think some people are trying to get PGs or additional collateral or something. I'm concerned an awful lot of businesses are going to go bankrupt in name and then reopen in the same business. And the lenders who had personal guarantees are much more likely to get paid in those cases.
Yeah. Okay, so thank you, very insightful. And with that, we'll take a break and thank our wonderful sponsors, both Odessa and Rinaldi Advisory. Lisa, I'll turn it over to you to handle this end of it, and we'll be back right after the commercial break.
Thanks, Vince. Okay, so yes, we'd like to once again thank Odessa as our platinum sponsor. Thank you all for joining us this afternoon for this very timely discussion. And thank you again to today's sponsor, Odessa, for making it possible. Odessa powers businesses globally, bringing efficiency to leasing operations from point of sale to remarketing. The Odessa platform enables your teams to adapt to the changing landscape, changing regulations, pay-per-use models, and even the current COVID-19 climate, by combining automation and intelligence with human ingenuity. See what's possible when you link the two together to help shape the future of equipment finance. Visit odessa.inc/why Odessa. Okay, so Vince, we are back. Okay. And what I'd like to do is just see if we want to put up another set of poll questions. They've been real. Oh, there it is. All right, great. Okay, Vince, back to you.
All right, so please take a moment to look at the poll questions and answer them as you can. Thank you. So on the note of questions, there's a couple of good questions that I think are apropos to some of the subjects, which may make sense to quite frankly address now. And one of them is something that Rob touched on before the commercial break, and it's from an anonymous attendee. It says, are you creating any contingency plans for a second spike in the virus? I know that's on a lot of people's minds. So, why don't we kind of go around the horn? And, John, haven't heard from you. What are you hearing from your clients on a potential second wave?
What we're hearing so far is they're so busy with the first wave, they haven't thought much about the second, to be honest. So perhaps the person asking the question is ahead of the curve.
Yeah, and I'm not surprised to hear that, because I think a lot of people are just, oh my, what's next? Especially, look, it's kind of hard, right? I think that we've all talked about downturns and defaults and so forth, but I'm convinced that May is potentially, and it will potentially get worse. I think May is probably the beginning of the first month where we're seeing the full effects of this disaster on our clients. May, June, July will be certainly telltale tales of what's happening, because now we're in the heart of people's cash flows really getting impacted. They got through the first month. The second month wasn't pretty. Maybe some applied for, the payroll protection or some of the other government programs, but now it gets dire. You're in month 3 and 4, and I think that, quite frankly, it's going to be interesting to see what effect this has. But so it's kind of hard, to your point, John, to focus on next waves when we're so caught up. But anyone else out there? I don't know. Terry, are you thinking about anything?
Well, I think the next wave is not necessarily in terms of the virus, but what we're thinking about, the next wave is in the deferral processes, which is what Rob was alluding to. That so most of our deferral requests came in the month of April, and they were deferred for 3 months. So you got April, May, and June. So that means come July, most of these contracts would pick back up with payments again. And we know that come July, a lot of the customers are still not going to be healthy enough to resume their full payments again. So that's the second wave that I think we're focusing on is additional payment deferrals for customers that might need it that next round. The regulatory guidance allows for up to 180 days 6 months worth of deferrals. We handled it 3 months to begin with. And so we'll see what that second round looks like.
Yeah.
Okay.
Hey, Vince,
Yeah.
I've been following the COVID stats very closely. I've been doing a lot of work with them, and some interesting things is, New York, the epicenter, really good news. It's down. New cases are down 73%. But at least as of this weekend, if you back New York and New Jersey out of the U.S. numbers versus a month ago, the U.S. is up 6%.
Mm-hmm.
And California up 31, Illinois up 43, and Texas up 44. So it is kind of spreading. That said, as of today, the national numbers, excluding New York and New Jersey versus a month ago, it's actually down 2%. So maybe we've crossed but there's definitely potential for. I was on a commercial real estate lending webinar a few days ago, and they did a survey of the audience. There's over 1,000 people. What the shape of the recession was going to be. Only 9% said it was a V, and 79% said a U, a W, or an L.
Yeah, it's a tough one, and I'll tell you, that's some great statistics, and you start to wonder whether, look, no one knows, but you start to wonder whether weather has anything to do with it in certain instances, because I'll tell you, as a lot of I was previously at Santander, a global bank for, started their business and was there for quite a number of years. They're they're actually the second largest bank in Brazil, on top of, some of their other countries. And there's a country where it has been fairly quiet up until now, but they're flipped, as they now start to enter fall and the beginnings of winter in the short term, cases there are growing really rapidly. And if you've noticed, for those who've been watching the news over the weekend, our government has added them on a banned list, which they hadn't done up until recently. So it's going to be interesting to see how this is going to sort of play out. But anyway, thanks for that insight. Getting back to some of our other points. Tom and John, you guys are more on you're obviously on the consulting side. You see industry data and really from individual companies and clients, and probably more so than I and Terry and Rob do. So I guess, can you give us any insights? What are you hearing from your clients in regards to what's coming next regarding new applications, closings, and bookings? What are you feeling? What's the pulse, John? Can we start with you and let us know what your thoughts are there?
Well, I'd probably give you the same response I did to an earlier question, which is that we're getting pretty much an across the board set of comments from clients. Some large bank leasing company, as an example, has said the same thing several of the panelists have said today, that they've been very surprised that their level of activity has held up as well as it has. And they're now thinking pretty positively about what the balance of the year could look like under the circumstances. We have other clients whose response is quite different, that new business volume activity and pricing activity is about as bad as they've ever seen it. These are usually the verticals that those leasing companies are in, a particular industry or subsegment equipment that drives the news that badly. But again, it's kind of all over the place. And we kind of made the original assumption that all of this was going to impact companies pretty much evenly across the board. Obviously, somebody at the low end of the credit scale more than others, but I don't think our initial reaction or guesstimate was accurate. I think it's going to be very different depending on which organization is asked the question.
Mhm. Yeah, it makes sense. Tom, any
Yeah.
thoughts? What are you seeing from your clients?
This is really a fascinating recession. I mean, all the economists say every recession is different. This is the ultimate proof of that. So much so relates to what Terry was saying earlier about that it didn't necessarily make much difference on credit quality, who was asking for deferrals. But things are so different in terms of what business can proceed and what can't, and it's not necessarily quality. It's a matter of distance to the customers. I think in general that this is a whole lot of change, and change does create opportunity. So to John's point, I mean, I think that there are manufacturers bringing things onshore to sort of fill supply chain gaps. I think that automation is great because machines don't get sick. I'm sure there's equipment being purchased to sort of protect workers and separate, I don't know, high cubicles or stations for slaughterhouses so that people don't have to stand right next to each other. So I think there is opportunity in those kinds of things, and that I would think that would continue, but it's going to be very, very niche specific.
Yeah, I tend to agree with you. I think it is going to be niche specific. And, on that note, we have an interesting question on niches and industry specificity from, Rob Hanna, and this is an interesting question. And the question is really apropos of, again, the subject at hand. And I think, we can focus on, whoever has the most subject matter expertise here. But a creditor is considering managing the overall beta of their portfolios versus looking at shutting down verticals such as the obvious ones, which is hospitality, transportation, etc. So I don't know. What do you all think? Who wants to lead off with that one? Rob, any thoughts from you?
Yeah, Vince, could you repeat that question?
Yeah.
I'm sorry.
A creditor is considering managing the overall beta of their portfolios versus looking at shutting down verticals such as hospitality, transportation, or et cetera. So big bank, you guys put a lot of focus on risk analysis,
Mm-hmm.
or the overall, is it more focus on industry, specific industry, or is it, the whole general portfolio?
Mm-hmm. Well, I wouldn't say that we've restricted certain industries at this point. I mean, we're still looking at transactions. However, the story is really what we need to get. We need to really understand, if there's a restaurant that's requesting financing right now, okay, given what we understand about the pandemic and how it could affect the restaurant, could you please explain to us why, you believe it's sensible to make an investment in your business right now and increase your debt service coverage requirements? So, we'll go through those questions and get the answers. We're certainly using, higher levels of discretion where we think we have much higher risk, whether it's, as I said before, geographic or by the type of industry that the client serves. But we're listening to people. I mean, we're trying to do what we can to continue to issue credit where it makes sense to do so. But it's definitely a lot tougher than it was a few months ago to do that comfortably. And we need to really understand risk better.
Yeah. Yeah, Terry, how about you? I mean, large portfolio, same thing. Apropos question. What are you seeing?
Yeah, I think we, as I mentioned earlier, we have a very diversified portfolio, and I think we've been looking at multiple strategies and all of those things, whether it be by industry, by equipment type, by state, just across the board. We've evaluated all of these different strategies and put into play the ones that we felt made the most sense for us. And we're going to continue to do that as we go forward, and then kind of do that same analysis in reverse, I guess, as a way to ease out of this when the time is appropriate to do so.
Okay, makes sense. All right. Yeah.
I've heard of a number of lenders using getting bank statements to validate what current cash flow is through a service like Yodlee or something. That it's one thing for a borrower to be optimistic. It's another thing that to see that they are getting reasonable cash flow today.
Yeah, that's great insight, Tom. Thanks for bringing that in. Large ticket guy like me doesn't necessarily think of that at times, but at the end of the day, that's so critical. You're absolutely right. And back to the deferral on our side, we look at companies, what's their balance sheet cash position, what's their internal cash flow, and so forth. And hey, if you can afford it, you can afford it, right? On that note, quite frankly. Good question from a dear old friend, Randy Haug. So since we're talking about deferrals and so forth and so on, what's your viewpoint post-deferrals? Like what happens over the next 6 months? We get through deferrals, we get into a more workout stage and potential defaults. Tom, since you're on the hook, we'll start with you and then we'll go around the horn. It's a very apropos question given the time. I personally will tell you that I think we're on the precipice of this, having spent a lot of my time in the restructuring area before my days in workout, right? A third of my history is ABL, a third is workout, and certainly a third or more is EFL. And so, typically, depending on the industry, yeah, the wave comes after, right? So, the first round sits on the line, you do a deferral, you do an extend and pretend, as I normally call it, and then you meet Jesus and or God, and here we are. So what do you think, Tom?
Yeah, well, they can't be passed too if they're extended. No, I'm very concerned after the first 90 days of deferrals that that if you look at revenue numbers like for restaurants, that there's some great numbers online by state, et cetera. For restaurant revenues, and even with most states open up, that they're still down 56%, and they're creeping up slowly. But I think an awful lot of people are going to self-isolate, and I think consumer spending is almost 70% of the economy, and it just that really we've got two separate problems. One is COVID, the other is this recession that was caused by COVID, but a vaccine isn't going to solve the recession. And oh, by the way, that we were kind of over leveraged to begin with, that commercial debt between 2008 and 2018 went up 42%. And we had a, remember, inverted yield curve. We were kind of due for a recession. So, I mean, I do think it's going to be painful.
Yeah, I tend to agree. John, what are your thoughts? You've lived with this before. You've seen this before. You've advised banks and finance companies alike and lessors alike. Tell us, what do you think?
No, I want to go back and answer that question as well as the earlier question that was presented about essentially, are we going to make credit adjustments by sector perhaps, or by vertical as opposed to across the board? We have certainly seen clients, some of them very large clients, some of them very substantial clients, who have made the decision to stop accepting business from certain verticals or certain spaces, not so much for the obvious reason that they're at the leading edge of delinquencies, maybe the leading edge or bleeding edge in a recession, but for strategic reasons. And we've come to call this the circle the wagons strategy. If we don't know how bad it's going to get over the next 6 or 12 months or whatever, let's make sure that we reduce the amount of targets we have that are shooting at us and the amount of ammunition we have to shoot back. And so what we've seen is what I've said a moment ago, that some clients are saying we used to accept X business or Y business, not credit grades, not credit score or credit model driven, but sector driven. And some of those sectors, A and B, for example, are very important to us strategically. We may be a captive, we may be vendor oriented, we may be a specialist company that has really developed a footprint in that space. And boy, we have to defend that space. And so the C and D space is something that's been perhaps opportunistic to us. We're going to let that go because we've got to keep our capital basically as dry as we can until we have a better understanding of what's coming at us.
I want to say sorry, I had to drop off for a second. I was disconnected, but thank you for that. Tom, what what have you seen, you two, on the credit side of with all your time at PayNet and what's have you lived through this before? What insight can you give us here?
I think the scores will still rank order risk. I mean, with the caveats of industry that, as I said before, that a given score level will have higher defaults. It's just going to be part of it. I think it makes tons of sense, as we said before, not to auto decision right now, but to have a whole second set of criteria, like Rob was talking about with why do you want to do this? The one thing I want to say just about the outlook that I think it will be tough. I do think that said, that when there is a vaccine, that it's going to be a huge psychological boost, that all of a sudden there'll be a lot of pent up demand and a lot of pent up desire to consumer spend. So I think that could be a key moment, but that's not all that soon, I don't think, or who knows when that is.
Yeah, it's funny because the little bit of noise we saw this morning really had us they had the market on fire for a little bit, right? So I do agree that when that vaccine occurs, it'll be an interesting dynamic. Terry, any thoughts on this question?
Well, as you start looking into the future, how are customers going to get out of this? I think it becomes individual situations with each customer and trying to gauge their ability to continue on. Once again, we have a lot of small micro businesses, and so there's going to be some that just aren't going to be able to survive from this, and maybe already have shuttered their business. And so we just have to understand each situation and move forward appropriately. History tells us during these times that if we make good decisions on which companies we think we're going to have to limp along with, that might be a good strategy, and it will work out in the long run. But we've got to have those good conversations with each of the customers to find out kind of what camp they fall in terms of, are they going to survive or not, and then move forward appropriately.
Yeah. Rob, what do you think?
Yeah, similar to what Terry said. I think, we certainly, I think we'll see that other wave of deferrals come in. And then I think once we see that second wave, we'll have a better idea of which clients in our portfolio are really under a lot of stress. And like Terry said as well, I do expect that there's going to just be a number of businesses who just decide they're going to shutter. It's just, they're in a situation where, really recovery from this isn't feasible to them, and they're just going to have to, take lumps and move on. We're certainly going to do whatever we can to work with clients. I mean, in our opinion, I think, even if it becomes a troubled debt restructure because it goes beyond that 180 days, we're going to continue to try and work out with clients the best we can. I think it's, a TDR that works out is better than one you write off. So, we're going to continue to just, do what we can where there's hope, or where there's, you know, the opportunity for these clients to come up with a strategy to work out to get their business back up. You know, there's this little bit of, I guess, the situation's a little unique in the sense that a lot of these businesses didn't have really any option to deal with this other than shut down because they were required to. So, you know, it's not necessarily maybe poor management or just bad discretion. I think, you know, there's a certain amount of, yeah, we understand, we're all dealing with this, and, you know, let's work to come up with a plan to get you back where you need to be. So I think you're going to see some of that spirit maintained through this, because it's, you know, it's different even than the recession where you're just, you know, the week got cold. If you're a restaurant and you can't open your place for business right now and generate cash flow, you know, it's tough. So.
Yeah, no, totally agree. And you couldn't have said it better. Yes, a TDR is a TDR, but when you get repaid on is always better. On that note, are you getting any relief from your internal credit rating folks, or any direction from the Fed on, you know, for our banking clients that are also dialed in, you know, are you getting any relief on TDRs from, has the Fed sort of indicated, hey, we get it, we understand it, just work through it and lay low and don't necessarily classify it as TDR? What, you know, I think you're our only regular
Well, I mean,
here today, so go ahead, Rob.
Yeah, I'll say that, you know, obviously we get 180 days before we can provide relief to a client without having to classify as a TDR, right? That's a big help. It gives us, you know, 6 months of room to work before we need to deal with reclassification, and obviously all that comes with it. You know, I'm curious to see if anything comes after that, right? I think, you know, over the next few months, we're going to hit that wall. And then, you know, I'm wondering if the regulators are going to look at certain, you know, segments or of the industry, certain industry segments, or, you know, maybe some other criteria to say, you know, maybe we give a little more time for TDRs to extend that from 180 days potentially. I don't know that we will see that. I think at that point, you know, we're potentially just going to have weakness in the portfolio. The whole point of TDRs is to really indicate that, right? So, you know, it's really hard to tell, and I don't know what to expect on the regulatory side. But I think it was nice that they actually responded really quickly and put that out there, because you know, you had some idea of what you were dealing with and how you might want to manage, you know, these deferrals and extensions for clients based on that. So if they had waited to do that, I think it would have been a little tougher for us to figure out our strategy. So.
No, I couldn't agree with you more. They have actually been, you know, very good about quick responses during this whole situation. So interesting question from Diane Williams, again, since we're on the subject of TDRs, deferrals, and everything else. You know, then this is a good one. Are you seeing any applications come in, or originations of applications for new business with either front end, you know, call it low-high structures, low payments in the beginning? I mean, you know, higher at a teacup as the line goes on, or deferred payments up front? I mean, are you finding anything? Terry, let's start with you.
One of the strategies that we deployed is we do a confirmation call with the customer before we fund a transaction, and we're having conversations with them in that call about their ability to make payments, taking on this new debt. And based on how those conversations go, one strategy that might come out of that would be to do a delayed payment or no payment for the first 90 days. So it's certainly something that we will consider. Nothing formal, though, in terms of mandating those types of structures across the board or in certain segments.
Yeah, John, any of your clients, you know, saying they're seeing a rise in this type of activity?
Really haven't had a discussion about those, to be honest.
Mm-hmm.
So can't respond.
Yeah, that's valid. Rob, anything you're seeing on your end with process?
I would say just in the market, Vince, we've certainly seen some vendor programs and OEM programs, you know, trying to promote maybe 90 to 6 month deferred payments, you know, to get people into equipment now, as opposed to, you know, waiting till this thing clears up. So yeah, it's out there, and like Terry said, we've seen some people make that request with us, and if there's a good reason for it and it makes sense. Whereas before, we'd probably give someone a 90-day deferred if they were creditworthy. Today, we're asking why they want that 90-day deferred, just so we have a better understanding of what's going on. But you know, I would say, you know, we kind of discussed this internally and tried to determine whether it was something we would want to make more available or promote it more to clients. But, you know, one of the concerns we had, or, you know, there's potentially a lot of speculation that a client might have about how this goes. And are we, you know, comfortable, you know, lending on speculation? So it's a difficult decision to make. If you're looking at it from your business, you could be creating problems for yourself, or you could be, you know, creating opportunities by making that product available. Either way.
Yeah, sure. So, well, to me, the $1 million question, right? It's all about, you know, approvals, good approvals, and then we get paid for risk, right? So I guess it begs the question, given the rapid decline in base rates and coupled with greater credit risk and credit losses, how are you all navigating pricing and your P&L through these tumultuous times? So I'll start with Terry, and then we'll flip it to you, Rob, and we'll see what our esteemed consultants have to say, if they're getting any feedback from their clients.
Sure. Well, I think there is a strong case, as we've kind of talked throughout this last hour or so, that the business we're funding today has elevated risk due to the remaining uncertainties ahead of us from this pandemic. And it was mentioned earlier, but I'll also give a plug for last week's Monitor podcast with PayNet. And in it, Amanda Hull from PayNet described how default rates at any score level will go up during times like this. And so we've tried to take that elevated risk into an account as we're pricing our new business. Much of our originations are done on a risk-based pricing approach. And so it's an interesting dynamic when you may try to tighten credit at the bottom end of the credit spectrum to insulate yourself from risk in uncertain times like this. But in doing so, it takes away some of the reward also, where you might be capturing some of your highest yields. So for us, it's always trying to find that right balance between the risk that we're approving on new business and then the reward in terms of pricing, so that it all kind of weaves in together to meet our P&L needs.
Okay, so there's really been no increase in internal transfer pricing or liquidity premiums and so forth and so on your end, Terry. Is that a fair statement?
Yeah, we're just trying to manage the pricing that we offer to our customers based on the risk that we see the new business levels at.
Great, fantastic. Rob, what about you?
Well, I would say similar to what Terry has said regarding risk and reward. I mean, obviously, it's like Terry, we do a lot of smaller transactions, model-driven business. We definitely use, you know, risk-based pricing in what we do, and we anticipate that there is a greater risk right now, and we're trying to, you know, increase pricing where we think it's appropriate based on those risk factors that we see. We too, like Terry had mentioned, we have layered in, you know, the COVID impact into our model. It's not so necessarily in the model, it's supplementary to the model, but so we're able to kind of look at that opportunity, add those COVID risk factors in, like location, industry, so on and so forth, as I had mentioned before. And just, you know, assume there's higher levels of risk, which potentially requires us to have greater reward. You know, we do anticipate we're going to have elevated net charge-offs as a result of this. And as I mentioned earlier, I mean, you know, there might be some opportunities where competitors that may have been lower rate players have tightened up a little bit, or maybe moved out of some segmentation that we like. So I think, you know, I think credit spreads should probably increase a little bit through this period. This is what we also saw coming out of the recession. And I anticipate that. I mean, as far as, you know, some of the, I guess that's really it. Sorry.
Yeah. Okay, no, that's a good point. So basically no floor levels or no increase in transfer pricing or anything. You guys are still monitoring and pricing risk as is. So the base rates have not caused, a certain floor level or what have you. Robert.
Not that I'd want to talk about here, Vince.
Okay, that's fine. No, that's fine. I mean, we're finding it all over. One gentleman has a question around TDR. TDRs are troubled debt restructurings, which are really endemic to the point that if you're a regulated institution and you give a borrower relief beyond what was originally stated, you have to list them as a troubled asset. So I should have started with that, but that's the explanation for that. So John and Tom, staying on the subject of base rates, given the decline in base rates, inherently we're all getting lower returns. What are you hearing from your clients? Tom, you want to start with this one?
What I've been hearing is that people have been raising their rates, not dramatically, but some. And if you look at it historically, it really, in this industry, rates or net interest margin is really a function of the economic cycle. That back in 2001, according to the ELFA's survey of equipment finance activity, average margins were 4.9% in 01. They dropped down to 2.9 in 07. By 09, they were up to 3.9. And then in 2017, they were down to 2.5. So there's this cycle. It goes with the economy. And, I predict that rates will go up, and I've been hearing them going up, and spreads. And I think that's going to continue for a while.
Okay, so you think spreads that are driven, so average life swaps and what have you, you see those increasing over time. Is that it?
Yeah. Yeah. Even if cost of funds is down, I think that the net interest margin is going to go up.
Mm-hmm.
Probably more. I mean, that Fed funds can't go down much more. So,
Yeah. John, what are your thoughts?
I've answered most of your questions so far by saying that there's no one answer, no one size fits all. But I'm going to change my response to this question. Every single client we've talked to over the, say, last month to 6 weeks, every one of them have said that they are seeing better margins and better spreads. In some cases because they're driving for them, in some cases because their base cost of funds has gone down separately. But here the answer is almost universal, that margins and spreads are getting better.
Mm-hmm. Yeah, sure. So, I'm going to pick an interesting question here. We're almost out of time, but given that this one is such a large part of what we do in our industry, Chris Dolch, within the rolling stock lending arena and with volatility within the used equipment market, tightening competition and capacity, does the shift to the dynamic capital loan structures to more protection to FMV leases, do we see a shift there? What do you think, John?
I've asked that question myself, actually, preparing for this session. We are not seeing that yet. We would certainly recommend it for our clients' consideration.
Yeah. So, Rob, any shift between loan versus FMV scenarios?
We do mostly loans for rolling stock. I'll just put that out there. So we haven't really seen a lot of change. We haven't strategically tried to implement any change for more protection necessarily. So it's not something we've talked about yet, really. I think from our perspective, it would be more, which types of rolling stock do we think are going to fare better through that? What type of borrower in that industry who's using rolling stock, or how are they going to fare? So we would probably manage that more on the credit side than on the structure side, to be honest with you.
Yeah. Tom, what do you think?
I haven't had any conversations on that.
Yeah. Well, look, I'm going to speak to this and tell you that, look, at Element, what we do is mostly leases, whether they be tracks or FMVs or anything else. It is a fleet management company. So we like the leasing model. As a past restructuring guy, and especially in the trucking sector, I will tell you that going into a downturn like this, and look, let's face it, the smaller truckers have gotten hit hard. So it's a little bit more challenging for them. I always like an FMV structure over a loan structure all day long. I like the fact that we're not transferring ownership. I like the fact that if it's not 60 within 90 days, you know, a borrower has to tell me what they're going to do. Either pay me or give me the collateral back. So some considerations for us who are on the lender side and so forth and so on. Sure, where it makes sense and the residuals make sense. And that's a tough thing to peg for our asset management team members, right? I think that, you know, to be competitive, you've got to make sure you could lend at the right residuals in that market, because otherwise you're taking on too much risk, and who knows. There's a lot of trucks on the market out there, and auctions have all stopped. But reality of the matter is look, from a pure credit structuring perspective, from a pure workout perspective, I would say it's hard to argue, you know, the benefits of being in a true lease versus a loan for a financial institution, be it a bank or be it a, you know, an independent or a captive for that matter. So, well, look, I personally want to thank all of you. One, it's been a great panel for all your time in preparation and getting ready for it. Two, to our, you know, gracious attendees who've hung in there and have had really compelling questions. And without fail, our sponsors, certainly Odessa and Rinaldi Advisory, and to our friends at the Monitor who make all this possible. So with that, Lisa, I want to thank you for giving me the opportunity to moderate this, and I will turn it over to you for final words.
Great, Vince, thank you so much. And to Tom and John and Terry and Rob, what an engaging conversation you all had today. So again, thank you. And yes, like you just said, Vince, thanks to Odessa and to Rinaldi Advisory Services. Two quick things. I wanted to let everyone know part 3 is next week on June 4th. And let me tell you, that's at 12 Eastern. And the panelists are Adam Warner from Key, Kurt Phillips from Wintrust, Dave Drury from Fifth Third, Dave Fate from Stonebriar. So we will put the link right here in the chat to register for next week. It's up right now. And lastly, there will be a survey when you leave the meeting for today. Gives us the feedback that kind of keeps us creating conferences and podcasts that are valuable. So again, thank you so much, everyone, for your time, and see you back here next Thursday.
Okay. Goodbye, all.
All right.
Thank you.
Bye-bye.
Thank you, everyone.